Stock market investing primer. Things you want to know about investing but are afraid to ask. If you're new to the world of investing, welcome. In this video, we want to help you crack the code, beginning with the most important foundational concepts and then moving on to defining and describing the investments, accounts, and steps that will allow you to put these concepts to use over time. Investing is not something that comes naturally. It's not like riding a bike. The reality is that the language of investing is often obscure, and the rules and regulations can be complicated. That said, investing is the best way to build your financial future. So, if you've been afraid to ask questions and get started, we encourage you to watch this video. The challenge is worth the effort. Let's get started. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about, I want to give you a stock market investing primer. Things you want to ask, questions you want to ask, things you want to know about investing but are afraid to ask. Let's start with a few words about risk. At the center of investing is something called risk. Like everything in life, investing carries risk. There's no way around it. The only way that you have a chance to make a gain is to take the chance that you might have a loss. It's that duality that makes the whole investing trip really interesting. Sometimes more risk means the potential for more gain, but not always. As an investor, your most important job is to understand the difference when the risk you're taking is giving you the opportunity for a greater return and when it isn't. In other words, you only want to take on smart risk that is appropriate for your situation and that carries potential for reward. So how do you identify smart risk? How do you know if a level of risk is proper for your situation? That means you have to define your something called risk tolerance, and you have to define your financial goals. Now, I will talk about financial goals and risk tolerance in the rest of the show, but just know that you got to do a little bit of homework to know what you're comfortable with. Risk tolerance in a nutshell means that the amount you're comfortable with losing, and everything is fine. Let's say you have a portfolio of 10,000. How much can you lose and not lose sleep? That's just in a nutshell, that's what it is. How much money can you lose and not lose sleep? That's what risk tolerance is. Now, I don't care, people can talk about complex concepts and complex verbiage, but the bottom line is, how much can you lose without losing sleep? That's what risk tolerance is about. So you want to make sure that you always get smart risk. Building a portfolio, there are two cornerstone topics that are important that you have to understand when it comes to building a portfolio. Building an investment portfolio is a bit like building a house. You need to start with the blueprint. In investing, this blueprint is your asset allocation, or the way you divvy up your money between the various asset classes, such as stocks, bonds, cash, and other investments. Your asset allocation will help determine both your level of risk, aka risk tolerance, as well as your potential for gain. So an aggressive asset allocation, for example, will be comprised largely of stocks carrying significant volatility, as well as the potential for significant growth. An aggressive portfolio would be appropriate for someone who is young, in their 20s or 30s, and saving for retirement because he or she has the time to ride out the downs. At the other end of the spectrum, a conservative allocation means investments such as U.S. Treasury bonds, certificate of deposits, or other fixed income. Also, short-term bond funds are also good. And this kind of conservative allocation scheme is most appropriate for an older person or someone who wants to avoid risk. So people who want to avoid risk, they're called risk averse. And this type of portfolio, I'm talking here about the conservative allocated portfolio, probably will not lose value, but will not gain much either. So a moderate portfolio falls somewhere in between. One thing I want to talk about is that as an investor, selecting and adhering to your chosen asset allocation is job number one. You got to be clear about where you're going. If you don't have no idea of where you're going, the GPS is not going to help you. So you want to be clear about what kind of asset allocation you want. And this is kind of important. Important. Now, asset allocation works this way. You can decide on a 50, 40, and 10 model. In other words, 50% of your portfolio will comprise stocks, 40% will comprise bonds, and 10% will comprise cash and cash equivalents. That's what it means if you hear 50, 40, 10, or 60, 40, or 55, 40, whatever combination, whatever combo that you are comfortable with. This is what asset allocation means. Before you even think about buying an investment, you have to think about what you need in terms of growth potential and risk control. Before you decide to buy, ask yourself, will stock ABC or fund XYZ fit into my asset allocation? If not, it's not the investment for you. The second most important concept in investing is diversification. In plain English, this means not putting all your eggs in one basket, or in other words, spreading your risk among many investments. So if one ship sinks, you will not lose the entire fleet. So guys, I want you to really pay attention here. We're talking about asset allocation and diversification. So in practice, speaking about diversification, this means that you need to own several stocks or several bonds, each with different characteristics. Even if you are convinced that you want an aggressive portfolio, you need to own a minimum of 10-15 stocks and preferably more. Diversification is not a magic bullet. It cannot guarantee a profit or eliminate the risk of loss. However, if you do not diversify, you are setting yourself up for a huge hit if your chosen investment falters. Think about that. Let me give you a very practical scenario. Let's say one investment equals roughly 20% or more of your portfolio's value. That's known as a concentrated position. That's a definite no, folks. If you're listening to me right now, please, if you have that in your portfolio, go back, speak to your financial planner, and just kick that concentrated position out of your portfolio. You don't want that. I'll talk about this in the next section of the show, but purchasing one or several mutual funds or exchange traded funds is an efficient way to diversify and can provide the foundation for your portfolio. So key things to remember here is that asset allocation and diversification are your friends, and you want to make sure that you model those two concepts to make sure they fit your risk tolerance, your financial goals, and whether or not you will need money. And that's called liquidity needs. If you have, you always, investors, experts are saying that you have to have a little bit of cash in your portfolio. You got to have cash on hand. You never know if stuff happens. You have an emergency, a big ticket item, something that happens, somebody gets hospitalized, you need to take care of a family member. Those things happen. So you got to have cash. You got to have cash so that you're not forced to sell under pressure. Another thing you need to think about when it comes to stock market investing is timing the market. Please do not try to time the market. This is another big no-no. This is a big no-no. There is a saying, timing the market is more important than timing the market. Let me repeat that. Time in the market is more important than timing the market. So your time spent in the market, how long you have held a stock, is more important than trying to time the moment you're getting into the market. Before you invest a penny, repeat those words. Even the most experienced investors cannot accurately predict how much and when the market will move in a particular direction. Many of the best performing days immediately follow market dips. So it's not about thinking about, oh, I'm going to try to get in the market at the right time. No. Do your research. if you have tools that allow you to buy to get into the market, use those tools, but you got to get in. All right. So what do you have to do? Get in and stay in. You need to carefully select and monitor your holdings, making adjustment as needed. But to be successful, you have to stay in for the long term. Otherwise, you greatly increase your chances of getting in and out at precisely the wrong time. That's what people are trying to say. Like you sometimes, I have nothing against day trading, don't get me wrong, but we've seen, and it has been reporting the news for a long time, that some of those day traders, when you get in and get out, you have not only you might be missing out on opportunities, but you also are at risk of having a huge tax bill. Why? Because you are incurring, if you have profits, you are incurring not capital tax gains, capital gains tax rather, but you will be paying taxes on those profits at your normal rate. If you were in the 33 or 35 tax bracket, you were paying taxes on those profits at 33 or 35 percent tax bracket. So timing the market is not really a right strategy here. Do not do that. Don't try to have concentrated positions. Try to diversify and also have an asset allocation plan in place. I will be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Q. We're also having a conversation around things you want to know about investing but are afraid to ask. I'm here today to answer all your questions about stock market investing. And if you love the content's clarity and quality so far, and you love how I just go about explaining everything to you, please hit that subscribe button and turn on the notification bell, and we'll be very happy to have you around, and we'll notify you whenever we drop a new show. You will receive all our shows. We release new shows every single day, rain or shine. Comment below, share, and like. If you have questions, and if the questions are pertinent, we will answer. Our team reads all questions and they will answer. Let's talk about dollar cost averaging. This is a prudent strategy. Sometimes getting started can be the hardest part of investing. The good news is you don't have to jump in with both feet. A strategy known as dollar cost averaging can help you ease over time. You can ease in over time. This is how it works. So let's say every month or every quarter, you invest a determined amount of money, regardless of how the stock market is performing. When the market is down and prices are low, you can buy more shares for your money. When the market and prices are up, you'll buy fewer shares. As an example, let's say you decide to invest $400 a month for a year. In the first month, you may purchase 40 shares of stock XYZ at $10 per share. If the price goes up to $12 in month 2, you will only purchase 33.33 shares. And if the price falls to say $8, you will purchase 50 shares. So the strategy here is holding steady at $400 a month. Remember what I said earlier, you want to get in and stay in. So time in the market is more important than timing the market. So by having this strategy of holding steady and having a specific amount of investment into the market every month, you are slowly building a strong portfolio. Of course, no strategy, dollar cost averaging included, can protect you against losses when stock prices tumble. And if the market were to go straight up, you'd better off purchasing all of your shares as soon as possible. But dollar cost averaging can be a prudent way to ease into the markets, finding your footing as a new investor. One thing that you have to be aware, though, is that this strategy involves a continuous investment in securities regardless of fluctuating price levels. So you need to think about your financial ability to continue your purchases through periods of low price levels. What I'm trying to say here is that choose an amount. In the example, I chose $400. Okay, maybe your budget does not allow you to do this. So how about $10 a month instead of $400 a month? Go with $10 a month. Nowadays, you have something called fractional shares. So you don't have to to have $1,000 or 10,000 to be able to buy to constitute a portfolio. You can start little. It's all about starting small. So the bottom line here is that you have to have the plan. You have to think about asset allocation and diversification, and you have to be consistent when it comes to dollar cost averaging. The key is to be consistent, to be perseverant, to be patient, and to constantly do it. So I've been talking about dollar cost averaging. Let's just have a conversation now about stocks. Starting with stocks. So top line, a share of stock is a share of ownership in a company, as well as a share of possible profits. Let me repeat that because it's important to understand the distinction between stock and bond. And everybody just keeps talking about shares. What does it mean exactly? So a share of stock is a share of ownership in a company, as well as a share of possible profit. So owning stock is a great way to participate in a company's growth potential. And while owning stocks carries a certain amount of risk, there are no guarantees, and past performance cannot predict future results. But historically though, stocks have been shown to be the best way to grow your money over time. When it comes to choosing a specific stock, however, you have to look closely. Companies vary by size or market capitalization. And they talk about, sometimes you see on CNBC or Bloomberg or in the Wall Street Journal or any other financial magazine, they talk about large cap, small cap, mid cap. So large cap refers to companies that have a large market capitalization. Those are companies that have their capitalization in the billions of dollars. Small cap is large cap usually starts around 10 grand. I mean, it's 10 grand. I wish. The capitalization starts around 10 billion. Mid cap has a capitalization between 2 billion and 10 billion. And a small cap is a company whose capitalization ranges from 300 million to 2 billion. And when we talk about capitalization refers to the total value of all the shares of a company's stock, right? So when we talk about big companies such as Apple, Tesla, Amazon, Microsoft, those are the biggies. Facebook, right? So those are the biggies. But there are also foreign stocks representing companies based outside the United States. So if you want to get more granular here, there are two styles of stock. You have growth and value. A growth stock is considered by experts to be poised for a rapid rise. So you want to think about high tech, for instance. A value stock is considered underpriced. So if we go even deeper here, stocks are generally divided into 10 sectors. I'm talking about information technology, telecom services, utilities, healthcare, financial, industrial, consumer discretionary, consumer staples, materials, and energy. And you have 67 industries within those sectors, such as retailing, banks, and building products. The ideal strategy is to invest in a diversified mix of stocks of different sizes, styles, sectors, industries, and countries. This will help you control risk, but it doesn't ensure a profit or eliminate the potential for loss. Now, this might sound to you very complex, but just hang in there and do not be discouraged. Here is where mutual funds and exchange traded funds come in, which I'll get into in just a bit. So I started from stock and shares, and they're called equities, by the way. Now let's move into bonds. So you've probably heard of something called fixed income investments. So those investments generally pay a specific interest rate over a certain time period, and they promise to return your principal at maturity. What I'm trying to say here is that, let's say you buy a bond from Apple. If Apple issues a bond, you're buying, let's say you invested, for instance, $1,000. Apple will pay you every quarter, every 6 months, or every year, something called a coupon. This is interest. If the bonds was issued at 5% coupon rate, then you're getting every year from Apple $50, and that's the interest. And at the end of the loan period, that's called the term. Then if it's 10 years, then Apple will refund you, not refund, will return to you your principal amount, the amount you lended them in the first place, the amount you loaned them in the first place. That's called the principal. So the 10 years will be, so today's date, if we were in 2020, by 2030, you have the maturity. So this is basically what it is. Now, a bond is right up there at the top of the fixed income list. A bond is like an IOU. So you lend money, and in return, as I said earlier, you receive a promise of repayment plus interest at a predetermined date. Bonds complement stocks because they focus on income rather than growth, and they are generally less volatile. This can be particularly appealing for older investors seeking to create a regular income stream. Even in some cases, experts have said that even younger investors can also find bonds appealing. For example, let's say you are working, your spouse is also working, but you have kids, you have a large family, so you have to think differently in terms of investments. You need a lot of cash, you need steady income. Don't forget though that with income, bond income, interest income, you also have some fiscal implications. You have to pay taxes on those quarterly or annually or annual or biannual interest payments. All right. That's not to say there is not some risk. With bonds, you also have risk. There are many types of bonds. For example, you have corporate bonds, government bonds, and municipal bonds, and each of which carries varying degrees of different types of risk, including something called default risk. And this is the risk that the issuer will go bankrupt and you will not get your money back. I mean, if you have a company like Apple, of course, there is no default risk. I mean, Apple has more than 100 or 200 billion dollars sitting in the bank, so you don't have default risk with Apple. But if you have a small company, of course, with the default risk being high, you also have the yield. In other words, the ROI, the return on investment that investors are asking also goes up. That's for instance what you have with the junk bonds. They're called high yield bonds, aka junk bond, because the default risk is so high that investors are asking to be compensated more for the additional risk they're taking by buying this kind of bond. In other words, by lending money to such a financially unstable company. Besides default risk, you also have interest rate risk. This is the risk that market interest rate will rise and the value of your bond will go down. There is an inverse relationship between bond prices and interest rates. So when interest rates go up, bond prices go down and vice versa. I have explained this concept in another show. You might want to double check that and learn more. You also have something called the purchasing power risk. This is the risk that you will lose ground relative to inflation. In general though, corporate bonds offer the highest yield potential at the highest risk. U.S. government bonds, which includes treasury bonds, notes, and bills, are considered the safest. Bonds are rated so you'll have a sense of the risk before you buy. So you have things like AAA, BBB. So you have three agencies that sort of cover, three agencies that do the rating right now at the global level. Of course, you have smaller players in regionally, but three agencies do the ratings. So you have S&P, so Standards and Poor. You have Fitch ratings, and the third is Moody's. So Moody's, Fitch, and Standard and Poor's. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation here around things you want to know about investing but are afraid to. Now I'm going to answer all the questions you have. Making the most of mutual funds and exchange traded funds. Let's talk about ETFs and mutual funds. So you might be thinking, at this point, it's impossible to evaluate all the choices, and you're right. Luckily, there are mutual funds and ETFs that can do much of the choosing and monitoring for you. So what's a mutual fund? A mutual fund pulls money from many investors and invests in a broad range of securities, offering a certain amount of diversification without having to choose individual stocks. But you still have to do some work because there are several types of mutual funds. So you have stock funds, bond funds, and something called blended funds, blended or hybrid funds that invest in both. They invest in both stocks and bonds. There are also sector-specific funds. So the amount of diversification you get depends on the mutual funds you choose. A good choice for many new investors is a broad-based stock fund. Mutual funds are professionally managed, so you don't have to spend time following the day-to-day market. But there are two fundamentally different approaches to consider. There's something called passive and active. Passive management and active management. Let's start with passive management. So passively managed funds, they are known as index funds. They are designed to track rather than beat a specific index such as the S&P 500. On the other hand, actively managed funds strive to beat the market. So an important element to consider here is cost, because index funds, for example, they're passively managed. They're just, you just set them up and that's it. So they generally have low fees, whereas actively managed funds can cost a pretty penny. The added cost can be justified if you think about it. For example, in the case of a small cap or international fund, when market information may be more difficult to obtain, you want to make sure that you get a fund that is available, that has the capabilities to collect that information. Always read the prospectus to understand the fee structure and how your money is invested. So besides mutual fund, you have ETFs. What is an ETF? An ETF is an exchange traded fund. This is another great way to simplify choices. With this kind of fund, with an ETF, you own a single security representing a basket of stocks that tracks an index. The main difference between mutual funds and ETFs is the way they are traded. Mutual funds trade at processed at the end of the day. ETFs trade like stocks anytime during the trading day. So ETFs are also professionally managed, though most passively, similar to index funds. They generally also have low fees but may charge a commission when you buy or sell. Let's talk a bit about cash and the cash equivalents. Cash is not the only balance in your savings account. It's also a type of investment. So cash investments, also called cash equivalents, they are low risk, but they also have low return potential. Remember, low risk, low reward, high risk, high reward. This is the duality you have to always think about when pondering investment strategies. So when I'm talking about cash equivalents, you have to think about CDs, treasury bills, and money market funds. Some short-term bond funds are also considered cash equivalents. A CD is also called a certificate of deposits. So, like any other investment, cash has its pluses and its minuses. It can be great for providing stability and liquidity, but if you're trying to build a long-term wealth, it's not really the best choice. Let's admit it, right? So the low returns may well be lower than the rate of inflation. In effect, you could lose money and limit the opportunity to reach your goals. So once again, it comes down to finding the mix that best suits your needs. So let's say you have the basics down. You understand the duality of risk versus return. You understand the important elements such as the important elements of portfolio management, such as asset allocation and diversification. You've decided you are a moderately aggressive investor looking for growth, and you've researched and chosen a couple of initial investments. Now, are you ready to buy? Not quite. There are other things you have to do, because there are a few more topics you should explore. For instance, types of investment accounts, the impact of taxes, and how to keep your portfolio going and hopefully growing. The idea here is not to jump into conclusion and saying, I'm ready, I've done all the research, I've read, I have watched CNBC, Bloomberg, I'm comfortable. No. The thing here is that you have to do more research, more digging to understand exactly what you're looking for and to act on it. Talking about acting on something, why the type of account you open is important. When you're simply putting money aside, whether for a rainy day or for something special, a bank savings account will usually do. You'll make a bit of interest and you'll have easy access to your money. That's pretty straightforward. We know that. An investment account is a different animal. It is offered through a broker and allows you to buy and sell investments. So there is usually a minimum deposit and possibly account fees, which vary depending upon where you open your account. You may also pay a commission to buy and sell certain investments. These commissions vary by brokerage, so best to do some comparison shopping before even getting started. The financial institution is one decision, but you also have to decide what type of investment account best suits your goal. Do you have several goals or one goal? Again, and the goals depend upon your family situation, your personal situation, and the financial objectives you want to reach. So you can open a taxable brokerage account, a tax advantaged retirement account, IRA. IRA stands for individual retirement account. So you can choose whether you want to have a taxable brokerage account, a taxable advantaged retirement account, or both. With a brokerage account, you can invest as much as you want at any time. That's if the brokerage account is taxable. With an IRA, however, you are limited to a yearly maximum contribution, much like you are if you have a 401k through your work. Another important difference between account types is how earnings are taxed. You are probably already used to paying income taxes on the interest income you receive in a savings account. That's because the bank will send you at the end of the year a form called 1099-int, int standing for interest, and this tax is due whether or not you actually remove the funds from your account. So it is kind of important to understand that. It is important to know that when you have a taxable versus non-taxable brokerage account, there are some differences that you have to be aware of. I will talk very soon about the taxable brokerage account, but just remember one thing before I talk about that. You want to make sure that whatever taxes you owe the government when it comes to your investment, you pay them, because the last thing you want is the IRS to attach a lien to your brokerage account. Because if you don't pay your taxes and you don't reply to the IRS notices, the IRS has the power granted to it by Congress to put a lien on your account, on all your assets, including your brokerage accounts, your cash accounts, your checking accounts, and so on and so forth. And the reason why is that in a taxable brokerage account, the rules are different. In this case, you'll pay either short-term or long-term capital gains tax on any money you make, but only when you sell an investment that has gone up in value. If you don't sell the investment, experts say the gain is unrealized. You realize, quote unquote, you realize the gains once you sell the securities. So short-term capital gains are taxed at your ordinary income tax rate and applied to investments. And those investments are specifically those you've held for a year or less. Long-term rates, currently 0, 15, or 20% depending on your income, they apply to investment you've held for more than a year. So when you hold investment for more than a year, the authorities call that capital gains. In other words, you hold in investments for more than a year and you sell them and you have a profit. This is a capital profit. This is a capital gain. So you pay 0, 15, or 20% capital gains tax rate on those investments. These taxes are assessed at the end of the tax year when you file your income tax return. Taxation of an IRA is different still. An IRA is a tax advantage retirement account. So with a traditional tax deferred IRA, your earnings grow tax-free until you withdraw them. at which time you will pay income taxes on them at your ordinary tax rate plus a 10% penalty before age 59 and a half. Plus, you may get an upfront tax deduction on your traditional IRA contributions. That's if you are covered by an employer plan. If you're covered by an employer plan, IRA deductibility is limited by income level. With a tax-free Roth IRA, things are a little different. So you don't get the upfront deduction, but both earnings and withdrawals are tax-free as long as you are at least 59 and a half and have held the Roth IRA for 5 years. This can be a great choice for a young person in a lower tax bracket. When starting out though, it's important to begin putting money aside for retirement, and the sooner the better. As I said earlier, if you remember, time in is better than timing the market. So you want to start in your 20s, and you're likely to be in good shape saving just 10 to 15% of your annual salary for the rest of your working life. Start in your 30s, and that goes up to 20%. In your 40s, 30%. Of course, there is no reason you cannot have both a taxable and a tax advantage account. It's all about your goals and your strategies. And this brings me to my next point. Right after this, don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous. We're still having a conversation here around things you want to know about investing but are afraid to ask. Today, I'm here to answer all those questions. So I was talking earlier about the fact that you can have both a taxable and tax advantage account. And that brings me to the issue, the question, the concept of tax efficiency. What does tax efficient investing mean? It's also smart to think about taxes. So after all, it's not just what you gain, but what you keep after taxes that matters. In general, investments that tend to lose less of their returns to taxes, for example, stocks that you plan to hold on for longer than a year, are good choices for taxable accounts. Investments that tend to lose more of their return to taxes, for example, stocks that you likely hold for less than a year, should go in your tax-deferred retirement accounts. Likewise, tax-free bonds would be redundant in a tax-free account. How do you stay on top of your investments? So making these initial decisions is part of the heavy lifting. Think about that. Once you have your investment up and running, it's best to take a long-term view. It doesn't mean though that you can ignore them. However, you should check in at least quarterly to make sure your investments are on track. At the end of the year, you'll want to re-examine your asset allocation and possibly rebalance. Basically, this means looking at the percentage of stocks, bonds, and cash in your portfolio to make sure it still represents the allocation you want. If not, you want to make changes ASAP. For instance, if stocks have done pretty well, it might be time to sell some and use the proceeds to buy bonds. Or if bonds have had an exceptional year, it might be time to sell a few in favor of some stocks. This is how you rebalance your portfolio. When do you get help? Even when you understand investing, it pays to get help once in a while. So a periodic consultation with a financial professional can help you deepen your knowledge and refine your decisions. But whether you work with a financial advisor or go it alone, the main point in this video is this. Don't be afraid to ask questions. Get the information you need and get started. All right, folks, this is the end of today's conversation. I want to quickly recap the conversation here. And I was just giving you a quick stock market investing primer, things you want to ask, things you want to know about investing, but are afraid to ask. So I spoke about risk, building a portfolio, the two cornerstone concepts, so diversification and asset allocation. Timing the market is bad, dollar cost averaging, stock, bonds, mutual funds, and ETFs, cash and cash equivalents, the kind of brokerage account you open, tax efficiency in investing, how to stay on top of your investment, and when to get help. I will see you another time. But until then, remember, stay marvelous.